taking you through withholding taxes. So our objective for today is that we want to first cover the general understanding and principles behind withholding taxes, and next we'll go through the different types of withholding taxes that we have. So the general principle behind withholding taxes is that they are a collection mechanism, mainly created by ZIMRA to be able to cover taxpayers that are not normally covered by the normal system. This, for example, delinquent taxpayers or non-residents. What withholding taxes can do, they can either be a final tax, depending on the type of withholding tax, for instance, shareholders tax, or they can be a deduction for a taxpayer's tax liability. Now this is, for example, we can look at your non-resident tax on non-executive directors. Next, let's look at the broad base of withholding taxes. We have three broad sectors. One that covers delinquent taxpayers, your non-residents or foreigners, and the third one will be your directors. So to start off with, we will cover your delinquent taxpayers. These delinquent taxpayers are captured mainly by your withholding tax on contracts, which is covered under Section 80 of your Income Tax Act. What that section states, in short, is a payer or an entity will withhold up to 10% of any amount payable if it exceeds on aggregate $1,000 in any year of assessment. The amount they withhold is 10%. Let us look at an example of this withholding tax. So let's assume that X Limited entered into a contract to buy raw materials from Y Limited for an amount of $5,000 in November. Y Limited did not or cannot produce a ITF 263, which is a tax clearance certificate. What will X Limited have to do? In this case, X Limited will have to withhold 10% of the $5,000, which it has to pay towards Y Limited. So they'll withhold $500, which they will need to remit to your ZIMRA within 10 days of making that payment. However, we need to understand that what if the contract was over a period of time and X Limited was, instead of paying $5,000 in November, was paying $500 a month over the next 10 months. Would X Limited still have to withhold the tax? Well, the Act says the aggregate amount over any year of assessment has to exceed $1,000. And the contract states that the amount that will be payable towards Y Limited is in excess of $1,000. X Limited will need to withhold $500 every single month. So in other words, they'll be withholding $50 every month for the next 10 months that they're paying Y Limited. Another question might arise from that is that what if X Limited only buys raw materials worth $500 a month from Y Limited? Would they still have to withhold the $50? In this case, the contract is not for the full $5,000. Therefore, for the first 2 months that they're buying these raw materials from Y Limited, X Limited will not need to withhold the 10%. Why? Because the aggregate amount at that point in time would not have exceeded the $1,000 threshold. However, from the 3rd month onwards, X Limited will need to withhold 10% from any payment they'll make therefrom to Y Limited. Why? Because the aggregate amount that they have now paid out to Y Limited is in excess of the $1,000 threshold. So a recap. 1, the payer of the amount has to provide a certificate to the payee, which is in this case Y Limited, when they withhold that amount of tax. And this is not a final tax, because while limited can then use that amount withheld to deduct from his tax liability. Next, we'll look at our directors. So there is a withholding tax on non-executive directors' fees. The section we'll need to look at for this is section 36J of our Income Tax Act, and this will be read together with the 33rd schedule. When we're looking at non-executive directors, we need to understand what a non-executive director is. And you've learned this under employment income. When you learned under employment income, when you looked at the definition of directors or someone who earns remuneration, non-executive directors are scoped out of that definition. Why? Because they are not liable to pay as you earn. And that is what we term a non-executive director, someone who is not liable to pay as you earn. If they're not liable to pay as you earn and they only earn director's fees, they are now termed a non-executive director and will have a withholding tax that will be withheld from those payments. The amount of withholding tax that will be withheld is 20% from the fees. So please note, this withholding tax is whether you're a resident or a non-resident non-executive, the withholding tax still applies. The next broad sector that we're going to look at are our non-residents. And under our non-residents, we have 3 taxes that are withheld from non-residents. First one being, there's a withholding tax on non-resident fees. Second, non-resident tax on remittances. And thirdly, non-resident tax on royalties. So our first protocol will be to cover our fees. What we need to understand there is that what are fees? These are amounts that are paid for technical, managerial, administrative, or consultative nature. And when we're talking about fees, the payer of that fees firstly needs to be a resident of Zimbabwe. Secondly, the person being paid, the payee, needs to be a non-resident. The service that they are providing needs to be, as stated, of a technical, managerial, or administrative, or consultative in nature. What amount would be excluded would be withheld now. That we'll look at when we cover all the other sections. Next, we'll look at remittances. Again, we need to understand what is a remittance. You can find that under the 18th schedule, where it now defines what an actual remittance is. But it will also be generally for what we call allocable expenditure. And allocable expenditure is similar to fees in that it's of a technical, administrative, and consultative nature. Now with remittances, the payer of the amount needs to be a non-resident. The person receiving the amount also needs to be a non-resident. However, the amount being incurred needs to be incurred outside Zimbabwe. It's only then will the amount being paid be a remittance. It is key to understand the difference between a remittance and fees. Fees, our payer was a resident and our payee was a non-resident. With remittance, our payer is a non-resident and our payee receiving the amount and providing the service is a non-resident. However, with remittances, the service being provided will need to be for a service in Zimbabwe, but the payment is being made outside Zimbabwe. It is key to remember that for remittances, that the payment has to be made outside Zimbabwe, but the service has to be being rendered within Zimbabwe. Next, we'll look at royalties. Again, for royalties, we had to look at the definition of what a royalty is. This, we have to look at the 19th schedule. This again will define what a royalty is. And the key issues with the royalty is that it is for the right of use of intellectual property. Again, I said a right to use any intellectual property. This would, for instance, be a patent. If you're paying to use a patent and you're paying a non-resident for that patent, you will need to withhold, again, a certain amount on that payment, because the key again is you are paying a non-resident. And why are you paying the non-resident? You're paying them for a right to use certain intellectual property. If this is not a right to intellectual property, it will not fall under royalties. Please note, it will not fall under royalties. So be careful to confuse royalties and fees. Fees are generally for consultative, administrative, or technical in nature work, whereas royalties are for right to use intellectual property. One might confuse that with maybe rentals. Rentals are only a right to use fixed property and not intellectual property, therefore they are not royalties. Now, what amount is charged when we're talking about non-resident taxes? The general figure for all non-resident taxes is what will be withheld is 15% of whatever payment is being made. Secondly, when is this amount due to Zimra? It will be due 10 days from the date you make the payment. So our rate is 15%. Our due date is 10 days within the payment within the payment period. Next, we'll look at what one might call dividends tax, or the better term for it, as it is in the Act, is shareholders tax. This is both for non-residents and residents. Now, when is your shareholders tax withheld? This is withheld from any distributions made by a local entity to their shareholders, whether that shareholder is a resident or a non-resident. And note, I said distributions. At times, it's not always a dividend, but any distribution that is made by an entity to its shareholders, that entity will need to withhold a certain amount of tax. Now, what kind of entities need to withhold? These entities are listed under paragraph 2 of your 15th schedule. You will need to read that to understand where our shareholders tax does not apply. For instance, we're looking at statutory entities. When these statutory entities like your ZESAs or NASAs make distributions to their shareholders, there is no withholding tax made there. And it also does not apply when a local company pays a dividend to another local company. There is no withholding tax applicable there. What is the rate for shareholders tax? If the entity is a listed entity and is making a distribution, it will withhold 10%. If the entity is a non-listed company and the listing, please note, is listing on the ZSC, Zimbabwe Stock Exchange. If the unlisted entity, it will withhold 15% when it makes a distribution to its shareholders. Now next we'll look at our final withholding tax, which is resident tax on interest. Interest being amounts given or earned from deposits with financial institutions. When they pay out this interest, there's a certain amount of withholding tax they withhold. For the source, we'll need to look at section 34, and this will be read together with the 21st schedule, which defines what interest is, what deposits are, and what financial institutions are. Key terms again is we need to know what the financial institution and which financial institutions are covered under this withholding tax. There are certain financial institutions like your building societies, when they pay out interest, that interest is not withheld because it is specifically excluded from the definition of financial institution. The rate at which the withholding tax is withheld is if it is just a loan or banker's acceptance or a treasury bill, the financial institution withhold 15% from the interest payment. However, it is a fixed term deposit up to a 90-day fixed term deposit. The amount withheld is 5% of the interest. Now, when's the due date for this payment? It will be within, again, similar to your non-resident taxes, within 10 days of making that payment, your financial institution should remit that amount withheld to Zimmer. Or the commissioner may state a certain time frame within which to remit, but this is up to the commissioner's discretion. The general rule is within 10 days of making the payment. So I thank you and good luck with your studies.